So I was just checking our syllabus, and I truly cannot believe how close we are to the end of the semester. It is truly amazing to me. We are in Module 13. My goodness, there are only 14 chapters that we're covering, so we are just about at the end, and you guys probably feel like you've earned it on the way here, and you have. So this is not going to be the most pleasant chapter by any means. This is notoriously one of the trickiest areas of the tax code. The way they built the code is ugly. I have mentioned this in class multiple times leading up to this point. Deferring, but lucky chapter 13 is here. So here we go. So we really only have one learning objective, and that's to determine the amount and character of the gain or loss on the sale of business property. And we're going to see that really we've covered the amount, right? We've beat that to death to this point in the course. Amount realized minus adjusted basis, realized gain, generally recognized gain. We've talked about the handful of things that aren't recognized gains. Now it's all about character. So recognized gain or loss on disposition, gains that increase taxpayers' gross income, losses that decrease taxpayers' gross income. That's what it means to recognize. We know now that almost all realized gains and losses are recognized. We have covered a number of exceptions, however, things like the wash sale rules. And now we've covered new things in the last module. We did involuntary conversions. We did like-kind exchanges. So we've done a number of things that have tripped that up. But for the most part, still, we live in a world where almost all realized gains and losses are recognized. Maybe the one large category is personal losses. Okay, so remember, we have also discussed this notion of character, right? And we have individuals of character here. Well, okay, maybe not all of them. But we know that character counts, right? So, and the reason that matters in large part is because rates differ, or at least that's one of the primary reasons. So ordinary rates now for individuals are 10 to 37%, whereas capital gain rates can be as low as 0% or 15% or 20%. So generally speaking, for an individual, capital treatment is preferable, right? Especially with a gain, because we pay less tax. There's no tax rate difference for corporations. This really isn't a corporate class. Presumably you will have covered this, but it always is nice to draw that contrast. With corporations, a net capital loss is simply limited, and there's nothing you can do with a net capital loss but wait to generate some capital gains or carry back, carry forward. So here's a quick example of corporations, and I promise we'll try not to deal with them ever again. Hogwarts Corp generates a long-term capital gain of 55, short-term capital loss of 100,000 in 2018, and 400,000 of ordinary income. So when I take the 100 and the 55 and net them together, I get a net capital loss of 45. Because a corporation can't do anything with that, their taxable income remains 400,000. Of course, I've assumed no carryback. Really, the only way for Hogwarts to ever recognize a capital loss is through the generation of a capital gain. But we need to recall that property used in a trade or business is not capital property. So the presumption here is, look, I appreciate that corporations can't carry back a net capital loss, but the reality is they don't really engage in many transactions, at least on the surface, that would create capital gains and losses, because property used in a trade or business is not capital property, right? It's on the not list. So ordinary gains and losses come from the sale of ordinary assets. Check, I got it. That's pretty straightforward. Yeah, cap gains and losses generally come from the sale of capital assets. Also true. So here's our not list, right? And you can see number 2 being the primary item we're going to talk about in this chapter, which is trade or business property, not a capital asset. Okay. So ordinary assets, we know, therefore, are the things used in a trade or business, inventory, anything held for less than a year. And if a taxpayer sells ordinary assets at a gain, it's an ordinary gain taxed at ordinary rates. If they sell an ordinary assets at a loss, they are allowed to deduct that loss against their other ordinary income. And we've been through the individual NOL rules, and you see that if you create an NOL, you might get into some problems related to the deduction of an ordinary loss. But for the most part, you get to deduct your losses. So here's a chart from a separate book, and it's going to break down what we just discussed. And so really, if you look at, let's start in the middle column, for example, investment or personal use assets, right? Because the vast majority of those are capital assets. And if they're held short-term, it's a short-term capital. If they're held long-term, it's long-term capital. If we look in the far right, inventory and the accounts receivable that come from that inventory, that's just ordinary income, right? That's you generating ordinary business income. That's ordinary, and it doesn't matter how long you held the inventory, although, of course, it's good management practice not to hold inventory long. We're focused on this column on the left for trade or business property. And we're introducing something new, because what this says is if you hold that property for short term, then it's ordinary property. And that's within the definition that we've structured because it's on the not capital list. However, if you hold it for more than 1 year, we call that section 1231 property. And it is the definition of 1231 property is trade or business property held for more than a year. And we're going to see that we're going to treat that differently than we would otherwise. Okay, so here's the rate differential and the loss limitations. I'm not going to beleaguer this. Again, you can certainly freeze the video and read through this screen again, but we have covered all this before. Okay, so here we are in our 1231 asset world. So we've decided there was this world of trade or business property. We said it's not capital property, but what we're going to see is it's also, if it's held for more than a year, it's probably a 1231 asset. So that's depreciable assets and land used in a trade or business and held for more than 1 year. And I like to think of 1231 as being broken down into 3 separate buckets. Pure 1231, and that's land, because land is non-depreciable. 1245, which is personal property and intangibles. And remember, now personal property doesn't mean personal use property. That's all property that's not real property. So that takes us over to 1250 that says depreciable real property is 1250 property. And of course, real property is real estate, land, and things that are attached to it. Okay. So if a taxpayer recognizes a net 1231 gain, so they go through, they gather up all the 1231 assets that they sold during the year, and if it nets to a net gain, they actually treat that net gain as a long-term capital gain. Okay, now recall, trade or business property held for more than a year is not a capital asset, but we are going to treat that gain as a long-term capital gain. So they're changing the rules on us. If, on the other hand, we add all those gains and losses together on 1231 property and it's a loss, you treat it as an ordinary loss. So really, like before we even leave this slide, let's make sure we understand this truly is the best of both worlds. If it's a gain, treat it as a long-term capital gain, capture preferential rates. If it's a loss, treat it as an ordinary loss, not subject to the same limitations. So really, this is a pretty good place to come out. Now, we're gonna walk back from this rule before we're done with this module, because what could happen is some of the depreciation could be recaptured as ordinary. And I don't particularly care for the phrase recapture, but that's what it's called. You'll hear me refer to it as recharacterized. So we're going to recharacterize that capital gain as an ordinary gain. But don't worry, we're going to get there. It's just in the second half of this video. Let's focus for now on 1231. So what's not in 1231? Property held a year or less, right? By definition, it has to be held for more than a year. Non-personal use property that results in a net casualty loss, right? Casualty losses, we know, get treated a little bit differently. Inventory is out of there, right? We know inventory from that chart we saw a few slides ago is always treated as ordinary. Copyrights and artistic compositions and accounts receivable arising from the sale of inventory. Okay, and again, if we net all our 1231 transactions during the year and they're a gain, it's a capital gain. If we net them all during the year and it's a loss, it's an ordinary loss. Okay, so here's a flow chart we're going to go through the 1231 process, and at least for now I've blocked out what we don't know. So if I net to a gain, we would see, okay, net all 1231 gains and losses in step 2. If it's a loss, it's ordinary. If it's a gain, it's long-term capital gain. Okay. Net gains are capital, net losses are ordinary. Awesome. So let's go back in our Wayback Machine. Deductions are worth more at a higher marginal tax rate. And of course, we'd rather pay lower marginal tax rates on income and gains. So if regular or ordinary rates are 35% and long-term capital gain rates are 15%, what kind of gains do we want and what kind of losses do we want? So this is just exploring that best of both worlds concept. So if we had a $10,000 gain, if we had to pay ordinary tax on it, it'd be $3,500. If we paid capital gains tax on it at 15%, it's only $1,500. I'm pretty sure what kind of character gain I'd like. If we flip that over and treat it as a loss instead, well, I'd rather have the ordinary tax benefit of $3,500 than the capital loss benefit of only $1,500. So you can see that really we have a really good outcome here under 1231. So Bill's business has a number of 1231 assets that it would like to sell. And it's 4 of them, assets A, B, C, and D. And if you look at the basis and the fair market value, you'll see that A and B would both be sold at a loss, and C and D are both going to be sold at a gain. Now, Bill is intimately familiar with how 1231 works. And so he makes a unique choice. He says, you know what, I think what I'm going to do is I'm going to sell all the assets this year. So that's all of them. And he nets a gain of $700. And of course, that would get capital gain treatment under 1231. And he says, yeah, that's a pretty good outcome, right? So I'm going to pay taxes on that $700, whatever it is. But what if instead Bill says, you know what, I think what I'm going to do is sell everything at a loss, only assets A and B this year. And I'm going to capture the benefit of a $5,000 ordinary loss. And then on the first day of next year, I'm going to sell assets C and D and generate a capital gain of $5,700. Now, think about what he's just done. So we have the same $700 net gain or loss, but look at the tax rates that are going to apply to each of the loss as ordinary and the gains as long-term capital gains. And you can see that this is an arbitrage opportunity that the IRS is super uncomfortable with. So they have something called the 1231 look-back rule. And what that says is you have to look back 5 years and recapture, which means recharacterize, any ordinary losses as ordinary gains this year. So this doesn't mean that we're changing the amount. We're really only changing the character. So let's imagine that we're in Bill's position. And so we generate that $5,000 ordinary loss in year 1. All that's legit. It stays exactly as it is. But now in year 2, when he generates that $5,700 capital gain, he's going to look back in the previous 5 years. He's going to see that he generated a $5,000 ordinary loss, and therefore he's going to have to treat $5,000 of that gain as ordinary this year. And only the additional $700 is capital gain. So by doing so, what it does is it takes the power away from the taxpayer to engage in this exact sort of tax planning technique. So again, this is only for gains recorded after losses. You look back, and if you generated 1231 losses in a prior period that were treated as ordinary, you recharacterize the gain in the current year to reflect that. Okay, so the good news is that gets rid of that hidden box, right? So now we're looking at it and we say, okay, we're going to net our 1231 gains and losses together. If we have a look back that applies, so we look back 5 years, were there any 1231 ordinary losses in prior years? Yes? Oh, well, in that case, you got to treat the gain as ordinary to the extent of that loss. Otherwise, it falls down to the long-term capital gain, just as it did before we had the look back rule. Okay. This next box is the one that really seems to throw students, and it is notoriously difficult, and it relates to something called depreciation recapture. And again, these aren't terms that I made up. Recapture is the commonly used term, but it really means recharacterization. Okay, so let's start with Lola. Lola owns a business asset she placed in service 6 years ago. The original basis $50,000. It is now almost fully depreciated. In fact, her basis is down to $6,000, and she's going to sell it for $10,000. And this is her only asset sale this year. There's no 1231 look back. Okay, so how would we treat this sort of sale? So if we look at the history, she bought it for $50,000. She's taken $44,000 of depreciation deductions. That's an ordinary deduction, right? That offsets your ordinary business income for the past 6 years. So if she has a 35% marginal tax rate, she will have generated $15,400 of tax savings. That's the $44,000 times 34%. But this is 1231 property, right? It's an asset used in a trade or business held for more than a year. So any gain under 1231 would be recharacterized as a capital gain. The cap gain rate is 15%. So she's only going to pay tax of 15% or $600. So is it possible that the reason she had any gain at all is because she simply over depreciated the asset? Now look, I know Lola would be offended by that. She would say, look, I followed the rules. I went to the depreciation table. I calculated depreciation exactly as I was supposed to. But what happened is that depreciation lowered the basis to less than the market value, right? So that leaves $6,000 a basis, but the fair market value is $10,000. So really, economically, she did in fact over depreciate that property. Should there be a tax break for that? Because that is exactly what has happened. She's taken that deduction at 35%, and then the gain comes back around at only 15%. Again, this is something the IRS simply is not comfortable with. So the next code section is code section 1245, or sometimes called 1245 full recapture. I'm not sure what recapture is, but recapture, I do know what that is. So 1245, as we know, remember back a few slides ago, we said, hey, what's under 1231? And we said there's pure 1231. That was land. Land doesn't depreciate. 1245 was personal property and intangibles, and then 1250 was real property. So here we are in the personal property and intangible category. And what has to happen is you're going to treat the lesser of the gain recognized or accumulated depreciation as an ordinary gain. So you're going to recharacterize that away from what 1231 said. That recharacterization is under 1245. To the extent there's any gain above that amount, then it's treated as 1231 gain. And note, there is no depreciation recapture on an asset sold at a loss. And that makes sense in a lot of ways, right? If 1245 recapture is supposed to pick up economic over depreciation, then to the extent you sell property at a loss, it must be that you under depreciated it. Therefore, in theory, you would be entitled to that additional depreciation. If it's a 1231 asset and the net assets are sold at a loss, that's an ordinary loss. So another way of thinking about it is to say, treat the gain as ordinary for the lesser of the gain amount or, not of, or the depreciation taken. Okay, let's look at our Lola example in numbers. So the amount realized is $10,000. That's what she sells it for. Her basis is $6,000. Her realized and recognized gain or loss, therefore, is $4,000. She's taken depreciation of 44 over the life of the asset. She's going to characterize as ordinary the lesser amount of the gain or the depreciation taken. In this case, the gain is clearly less than the amount of depreciation taken. All 4,000 is treated as ordinary. There's no other gain or loss left, so there's none left to be 1231. Okay, let's change it slightly. Let's say instead she sells it for 40,000. Okay, so now 40,000 minus her basis of 6,000 is a $34,000 recognized gain. Compared to depreciation taken is 44,000. Well, the gain is still the smaller amount. Therefore, all of it is treated as ordinary. So that'd be an ordinary gain as opposed to a 1231 gain. All right, let's change it one more time. Let's bump the sales price up to 55,000. So now her recognized gain is $49,000. She's taken depreciation of $44,000. The lesser of those two is the depreciation taken. As a result, she only recharacterizes as ordinary $44,000. The remaining $5,000 of that gain, that's the 49 minus the 44, is $1231. And when you think about it, that makes perfect sense. If you were to flip back, you would see that Lola purchased this asset for $50,000. Really what's happened here is that asset has truly appreciated in value. It went from $5,000 to $55,000. That feels a lot like what a capital gain is supposed to represent. As a result, you can see that the interaction between 1231 and 1245 does exactly that. It captures the true appreciation and treats it as a long-term capital gain. Well, at least a 1231 capital gain, and then to the extent we mix it up with losses and gains later, that really determines its character. But at least from the outset, it's designed to treat that as a capital gain. Okay, one more. Let's say Lola only sells it for $3,000. Now, of course, she recognizes a loss of $3,000. The depreciation taken is the same, 44. However, there's no recapture on losses. Remember, depreciation recapture only applies to gains. As a result, we would say, well, that's just a 1231 loss, and probably going to be an ordinary loss if it's the only loss this year. Okay, so yeah, that's our 4 scenarios for depreciation. Let's see what we've learned. So if a taxpayer sells or disposes of 1245 property, they're going to encounter one of 3 scenarios. They're going to recognize a gain created solely through depreciation. And think of that as that was columns 1 and 2. In fact, let's just go back and look. Right, that was columns 1 and 2. And you can see that what happens is all of the gain is recaptured as ordinary. They can recognize a gain created through both depreciation and actual asset appreciation. That is scenario 3, right? And you can see that what happens is we bifurcate the gain into the ordinary portion and the 1231 portion. Or lastly, they recognize a loss, in which case no recapture applies and it just falls down to a 1231 loss. Okay, 1245 covers personal property. What about real property? So recall, real property was classified as 1250 property, not 1245 property. So depreciable real property, such as an office building or a warehouse, sold at a gain is subject to a recapture called 1250 depreciation recapture. And this is sometimes called partial recapture. So there's a modified version for corporations, but we're not going to worry about Section 291. Presumably, for those of you that have taken 332, you covered it then. All right, but Congress loves real estate. So rather than make taxpayers recharacterize gains as ordinary to the extent of depreciation taken, they made a slightly different rule. They said, you know what, we'll only make you recharacterize your gains as ordinary to the extent they relate to accelerated depreciation. So in this case, accelerated means not straight line. So let's take a look at the 2 tables that primarily cover all real property depreciation and look and see how they're depreciated. What do they have in common? They're both straight line. One is straight line 27.5, the other is straight line 39 years. As a result, since I want to say 1986, and the book spends way too much time beating this one up, there's been no such thing as 1250 depreciation recapture. So I wish I could stand here and tell you, hey, we're out of the woods. Don't worry about it. Nothing is recaptured under Section 1250. In fact, the term that's commonly used is they would say the depreciation goes unrecaptured. If an individual sells real business property again, to the extent there is unrecaptured depreciation, it is treated as a long-term capital gain, but it's taxed at 25%. This is sometimes called partial recapture, right? So you really only recapture the accelerated portion. Well, since the accelerated portion doesn't really exist anymore, everything is unrecaptured, but we don't escape recharacterization in total. It's the same character, it's long-term capital gain, but it's taxed at 25%. So if you recall, we had conversations about this back when we did that wonderful cap gain netting process. And we said, hey, remember that unrecaptured 1250, that column taxed at 25%? I said it could only be gains, and eventually we'll get to it. Yeah, well, here we are. Okay, so again, we're not going to worry about corporations. Go ahead and look up unrecaptured. As near as I can tell, it's not a real word in the English language, and yet it is widely used in the tax literature. Okay, so let's do the Lola example again, except Lola is going to sell real property. All right, let's look at our first column. So she sells it for $10,000. Her basis is $6,000. She has a recognized gain of $4,000. The depreciation taken was $44,000. And you can see that the amount of depreciation that was unrecaptured is all of the depreciation. And as a result, she's going to treat that gain as unrecaptured $1,250 gain taxed at 25%. If we go to column B, the next column over, $40,000 minus 6 is $34,000. Depreciation taken is $44,000. The amount of unrecaptured depreciation is $34,000. Therefore, that amount is taxed as a long-term capital gain at 25%. If we go to the third column, 55 minus 6, that's the $49,000 gain. $44,000 depreciation taken. We bifurcate it into its two parts. $44,000 is unrecaptured $1,250, long-term capital gain taxed at 25%. The remaining is true $1,231 and will just be thrown into the $1,231 netting process, as we've done. And then lastly, we have our loss column, and you can see that recapture does not apply to losses, and so as a result, that just falls to a 1231 loss. So if you were to compare this with the personal property slide we did for Lola, you would see that there is only one difference, and that is the character of what we do with the depreciation. Before, we treated it as ordinary. For real property, for individuals, we treat it as unrecaptured Section 1250, taxed at 25%. Awesome. A few other additional odds and ends we need to worry about with recapture. So what if instead of sold, property is gifted? Now again, you don't see a lot of business property being gifted. I don't want to say it never happens, but it could happen. So you might argue that this rule is here solely to prevent abuse from happening. Oh, I'm going to get rid of recapture by gifting it to someone and blah, 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 right? So if property is gifted, the recapture carries over, I shouldn't say to the donor, carries over to the person who's the recipient. So the fair market value is $5,000, basis $2,000 at the time of the gift. Accumulated depreciation is $6,000 at the time of the gift. So what you would say is, look, there's recapture potential here of $6,000, right? Now it's not going to be all $6,000 because the gain amount's lower. So if it were sold for $5,000 by the recipient, they would have to treat $3,000 of that gain as ordinary because the recapture carries over to them. If, on the other hand, it's gifted at the time of death, recapture does not carry over to the decedent. So that would imply that you take it in its market value, that'd be its new basis. You don't worry about recapture, it's gone. And then we talked about this in the last module. We said, hey, when there's an installment sale, you have to recapture your gain in the year of sale. So let's just do this quick example to kind of confirm how that works. G sells property for 3 payments of $10,000. The adjusted basis was 16. The original purchase price of that property was 25. So it must be that if they bought it for 25, the basis is 16. They've depreciated it for 9. The amount realized is 3 payments of $10,000 or $30,000, and we're assuming a reasonable interest rate applies to this installment sale because otherwise we'd have imputed interest problems. So let's calculate the realized gain, right? That's the $30,000 of amount realized minus $16,000. $9,000 of that gain is due to recapture, right? Because that's the amount of accumulated depreciation on that personal property. It's $1,245. So that $9,000 worth of ordinary recapture must be recognized in the year of sale, whether any cash changes hands or not. So as a result, the gross profit percentage needs to be adjusted to reflect that. So now the gross profit percentage you would calculate as 5,000 divided by 30,000. So remember, our gain was 14,000, but we have to recognize 9,000 up front. Therefore, the gross profit percentage is the 14 less than 9, or 5, over the 30,000 is 16.67%. So when they receive their first payment of $10,000, 16 2/3% of that is going to be treated as gain under the installment sale treatment. Okay. That brings us to the end of chapter 13, you guys. Thanks for watching.